Our market master of the day is Sanjeev Prasad. He's Managing Director, Co-Head of Kotak Institutional Equities. Sanjeev, good morning. Great to have you with us here. You know, last week you put out a note which was, you guys are known for speaking your minds and writing what you feel in terms of what you think. And there was an interesting play on the greed and fear theme, and the note was titled, "No Fear, Only Greed." So just wanted to start with that in terms of why you wrote that. And second, in that same note, though, you say that nothing negative on the horizon suggests a sharp correction. So how do you square the two, and where does it leave us? I mean, if you're looking to deploy money.
Well, it's a tough position to be in if you are a fundamental investor, because on the one side you have stocks which are overvalued, and as we written in the note, the overvaluation increases as you go down the quality curve, the risk curve, the market capitalization curve. So the extent of froth increases, in disproportionate order of the quality of the company, market cap of the company, and so on and so forth. But having said that, this could well continue. You could see a big disconnect between price and value, which is the case currently, continuing for a long period of time. For the simple reason, we don't see anything negative on the horizon, which can result in a big correction in the market. If you look at the macroeconomic fundamentals of India, pretty strong. Growth is obviously pretty decent, and some of the other macroeconomic parameters which people have worried about historically, such as inflation, current account fiscal deficit, slightly on the weaker side, but clearly improving. If you look at the political setup, it looks like the BJP is going to come back to power. At least that's what the market has decided. So no negative news likely from that side. Global setup also looks pretty reasonable. At some point in time, the US Fed and other central banks will start cutting rates, so that should again provide some tailwind for the Indian market. And lastly, if you look at the position as far as Indian companies, household, government, etc. is concerned, there is nothing negative out there in terms of over leverage in the system, which should be a warning bell or something like that. So that's the lay of the land. On the one side you have a pretty decent macroeconomic setup. On the other side you have very expensive valuations. So I guess we'll have to just live with the two. In the sense, you'll have some amount of discomfort with respect to valuations, but I guess we'll have to just live with that.
Okay, that's a big statement, right? You're saying you don't see anything negative on the horizon that can result in a big sell-off in the market. And that's
barring the valuations.
Barring the valuations, of course. That seems to be everyone's concern, right? I mean, it's very, very hard to find value even in individual sectors now. So what do you do, Sanjeev? If you have an optimistic view on the market and you want to continue to deploy money, which are the areas where you have some glimmer of hope that, okay, here you have both valuation and growth?
Then you'll have to look at, individual pockets, more sector by sector, stock by stock. So thankfully, as of now, you have one large sector, which is the financial sector, where at least valuations look a lot more reasonable. And here the valuations are reasonable for most of the names. Whether you look at the large cap private banks, look at the PSUs, although they have run up quite a lot in the last few weeks, months. But at least you can get your head around the valuations over here. Most of the the better quality large cap private banks are in the low twos. One time forward price to book. If you look at the better quality PSU banks, now they are more like 1.2 to 1.4 times one time price to book. So, doesn't look that crazy, compared to historical levels. Yes, some of the public sector banks may be looking on the higher side, but having said that, their credit quality, etc., is far better than what we have seen in the past. Underwriting practice have improved, so I don't see anything negative out there. And then beyond the financial sector, I guess you'll have to just look at individual pockets where, like, for example, consumers, staples are discretionary. Obviously, you have a lot of struggle as far as growth is concerned. But hopefully, our view is that over the next 2-4 quarters, you start seeing some pickup in volume numbers. If you look at the valuations over there, maybe 10-20% overvalued in some cases, but at least I can live with them. In the sense they have good quality companies, generate a lot of free cash flow, high return businesses. So okay, similarly, pharma, healthcare services, again slightly on the expensive side, but again very good long-term businesses, so we can live with that. So the challenges beyond these pockets, of let's say financials, some consumers and pharma, healthcare, beyond that become a bit of a struggle. IT is looking expensive. The investment space looks very expensive, although the news flow there will be good, looks like. And as I was saying earlier, beyond that, if you look at the low quality names, some of the mid cap, small caps, they have been a tear absolutely. Many of them are up 300, 500% last, year or so without really any major change in the fundamentals. So I don't know how to deal with that part of the market. So we will probably just exclude that bucket for now. Just focus on the large cap names where you can find at least some value and stick with that.
All right. Hi, Sanjeev. Good morning and good to hear your thoughts. Sanjeev, what do you do with this entire frenzy in the PSU names? And I'm just looking at a few of these railway themes. They're just flying away. RVNL, IRFC. And mind you, these stocks are already up 3 or 4 times, in the last 18 months. What would you do with these PSU names? If you have them, would you book out? And is there anything that you see that looks interesting to buy from the PSU basket at these levels?
Nothing really, if you just want to stay invested in some of the PSUs, as I was saying, PSU banks are the ones where at least, you have some, valuation comfort. Something like SBI is about 1.4 times 1 year price, 1 year forward price to book. If you look at Canara Bob, about 1.2, 1.3. So at least you have some comfort over there. But beyond the PSU banks, absolutely no comfort on the valuations. And keep in mind the fact that it's not as if there's a big change in the fundamentals of many of these companies. For example, if you look at BPCL, HPCL, yes, they are making record marketing margins as of now, but that is only valid up to a point where the government allows them to make this kind of marketing margins, or if or crude prices continue to be at lower levels. The moment crude prices go up, obviously the marketing margins will come down. So investors are willing to take a call that their marketing margins will be high in perpetuity. I'm not very sure about that. Right? How do you get comfort on that kind of a thesis? The railway stocks you mentioned, absolutely no comfort over there, given the fact there's a big disconnect in terms of their fundamentals and the kind of valuation they're trading at. Many of them are at some absurd valuations of 50, 60, 70p. I don't know what sense it makes. In one of the interviews, we had talked about Indian Railway Finance. Corp. I mean, that company is now trading at more than $20 billion market cap, something like, 5 times price to book. I don't know how you justify the valuations of some of these entities now. It has got, by the way, got less than 50 employees here. It's a struggle trying to get your hand around many of these companies now.
No, absolutely. Point taken, Sanjeev. So one of the things, right, which comes as sometimes as a bit of a pushback to these what could be unsustainably high valuations, is that we are in a moment where there's a huge financialization happening, right? Domestic savings are coming into the market in a very large way, and that flow is not going to go back easily. It perhaps will keep rising steadily. How big of but there's no. I mean, how do you model something like that into valuations and what people are willing to pay for it? Because when mutual funds get money, they will deploy it. They may be uncomfortable, but it'll go in. So just your thoughts.
No, I agree. It's a very uncomfortable position for even the fund manager, right? You continue to get money. What option do you have but to deploy, as you rightly said? If you look at the amount of fund flow which is coming in last month, that is January 2024, you had almost 30,000 crores of money coming into domestic equity mutual fund, which is at record levels clearly. The monthly SIP rate has now gone up to something like 180 billion rupees, which is more like $2 billion plus kind of a number. So, obviously the fund managers have to deploy, but I just hope we are not losing sight of the bigger purpose over here, which is ultimately to act as fiduciaries for the people who are giving them the money, right? It cannot be a situation that just because they're getting money, we'll continue to deploy irrespective of valuation, irrespective of the fact whether this valuations make any sense or not, whether the fundamentals of this company is correspond to the valuation they're trading at. Somewhere, some of the active fund managers will have to start taking the call and start at least gently educating the people that, look, fine, you're giving us money, it's our duty to deploy, but be careful as to what you're getting into. I don't really hear that commentary from any part of the market as of now.
Okay, one final question then from my end before we let you go. I understand that there is no real threat in the market right now. Everything seems to be going well, but that is generally when the market doesn't oblige, right? Apart from valuations, is there any other concern that you have that the market should sort of keep on its radar?
Not really, as I said, it could be my famous last words for all nothing negative and then something boom, something goes wrong. Hopefully that will not be the case, because as I said, it's hard to identify a cause for a market correction. before the event actually. And this time around, if you look at the situation, there's nothing really negative with the Indian economy. It's doing absolutely fine. As I was saying earlier, all the macroeconomic parameters are in great shape. The political setup is fine, social setup is fine. Leverage is not really a problem when it comes to corporate, government, or household. So I don't know what is the trigger over here. Barring some extraneous event, like war, pandemic. Anyway, we can't forecast that, and I hope nothing like that happens anyway. Very hard to say what will result in a correction. All I can say at this point in time, you'll have to just live with the discomfort which we are in. High valuations, but yeah, it probably that's the lay of the land, and probably it will continue like that for some more time.
Well, always good hearing your thoughts, Sanjeev. Thanks so much for stopping by and speaking to us here on CNBC-TV18.
My pleasure.
Looking forward to having a chat with you in the time to come.